Now, right now, as I film in this video, I'm coming up on around 7 years of dividend growth investing, full-time, basically spending every single trading day, every single business day that the market's open, buying different dividend-paying stocks and ETFs, and adding them, stacking them in my long-term dividend growth portfolio. Now, over the last 7 years, I've basically taken all of my active income and bought different dividend-paying stocks and ETFs, so much to the point to where I currently have 7 figures invested and a portfolio that pays me north of $6,300 per month in dividends. And even though 7 years later, as of right now, I feel as if I know, for the most part at least, all there is to know about dividend investing, although of course you can never know everything. And looking back in time, there are definitely some specific things I wish I would have known from the start. So in this video, we're going to go through 5 of those. 5 of the most important things I wish I would have known when I first started dividend growth investing. And I guarantee you, absolutely guarantee you, especially if you're in your early days of investing, this video is going to help you substantially. So if you're currently trying to build out a dividend growth portfolio, or maybe just getting started in dividend investing, make sure to stick around, drop a like down below, and let's get right into the first thing. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So number 1, the very first thing that I wish I would have understood a lot better and thought of as a very important metric when I first started investing is understanding dividend growth rate, what it means and why it's so important. Now, according to Investopedia, dividend growth rate is basically the annualized percentage rate of growth of a particular stock's dividend over time. And dividend growth rate is very simple to figure out. Let's say a stock or an ETF pays you $1 per share per year, and the next year that same exact stock or dividend pays you $2 per share per year. Well, the dividend growth rate for that example would be 100% because the dividend moved up 100% year over year. Now, dividend growth rate is extremely important, especially for long-term investors, because if you can find different stocks or ETFs that might not necessarily have the largest dividend yield from day one, maybe something like SCHD, for example, that only has, say, a 3 or 4% initial yield, but SCHD's dividend growth rate is around 10% over certain time frames, which means that over time at least, SCHD's dividend growth rate has been positive, and it means that you're going to get paid more and more in dividends, at least if history was to repeat itself. Now, dividend growth rate is not necessarily something that instant gratification investors are really going to look at, but if you are building a portfolio for, let's say, 3 years, 5 years, 10 years, 25 years down the line, dividend growth rate is an extremely important metric. I've talked about it before on my channel, and dividend growth rate should be at the forefront of your stock picking, ETF picking journey, especially if you are a long-term dividend growth investor. The next thing that I wish I would have known, especially when I started investing, is probably the same exact thing that a lot of you guys also fell into. I think it's sort of a rite of passage for every single dividend investor to fall into this. And this, of course, is not to chase high-yielding stocks or ETFs. Now, for many of you watching this video, you know exactly why it's not necessarily a good idea to buy into a stock or ETF just because the yield is high, but for those newer investors, let me explain it to you. And I'll even give you a real example of what I fell into when I first started investing. When I first started investing several years ago, I invested into things that were yielding above 6, 7, 8% because I figured that if I were to spend $1 and I'm guaranteed, quote unquote, guaranteed 6, 7, 8% yield per year just as far as dividends, that I would get rich a lot quicker. But of course, it's not the case. Look at AT&T, for example. Back in maybe 2018, I started buying shares at AT&T, and then of course, AT&T cut their dividend by like 33%, and this was back in 2022. Now, this is even after AT&T not only paying, but also growing their dividends for several decades. And even though the writing was on the wall for telecommunications and AT&T specifically, I, as a newer dividend growth investor, never really thought too hard about the fact that buying something high yield might not necessarily mean that it's going to continue to pay the dividend forever. Now, I'm also not saying that every single stock or ETF that does have a high yield is bad to buy, but just be careful and never, not once, only buy into a stock or ETF just because they offer a high yield. Look at an investment as a well-rounded thing and use multiple screenings, multiple metrics in order to analyze an investment and see if it fits for your portfolio. The next thing I wish I would have known, or at least taken a lot more seriously when I first started dividend growth investing, was to buy ETFs first. Now, if you look throughout my long-term dividend growth portfolio, this right here, my tracker, you can see that although I do own several ETFs within this portfolio, there's a large amount of single stock names in this portfolio. And with this basket, there's definitely some single stocks that I'm very glad that I own, but there's also many in here, plenty of them that I wish I would not have owned in the first place. I personally think that there's absolutely no reason not to buy into high quality dividend growth ETFs like VU, SCHD, DGRO, DGRW, etc. and build out a foundation, something for your portfolio to sit on. And then later on, if you want to do some single stock picking, once you understand how to actually do the stock picking, at least to a certain degree, I think that's perfectly fine. But in the early days of investing, I wish I would have taken every dollar and just put it into something like SCHD or like VU until I really got the hang of things. But instead what I did is I was single stock picking like crazy, doing research, quote unquote, not knowing what I was doing back in the day, and buying into all kinds of weird single name stocks, which for the most part I've sold off and moved the money into other things, but it's something that I wish I would have taken more seriously from the start. Buy ETFs first. The next thing I wish I would have done a little bit better earlier on in my investing career is take diversification very seriously. Now, like I just showed you throughout my long-term portfolio, I currently have around 45 different positions, which is definitely considerably diversified, although I do own certain positions like 1,000 shares of Apple, like 1,200 shares of Verizon, like 2,800 plus shares of Realty Income, certain names that I most likely am a little bit top heavy on. And although I think it's perfectly fine that if you believe in a stock or ETF long term, there's no problem with putting a substantial amount of money into it and buy into it with all you got. But I do think, especially in the early days, being very diversified, which goes back to my main point about buying ETFs, especially in the early days, because of course ETFs are different baskets of stocks. Being diversified in the earlier days is definitely, at least in my opinion, going to lower your risk and is definitely going to help you until you get a grip on what you're doing. Now, the last thing that I think is very important, especially for newer investors, and this is actually something that I'll give myself credit for, I've done this pretty well since the start, and that's to stick to the plan, stick to your strategy, build a strategy when you first get started and stick to it. Now, my strategy since the start has been pretty simple. It's to buy into different dividend-paying stocks or ETFs that I think are going to move up in price over time. And on top of that, they all need to pay a dividend, whether it's a small dividend like Apple pays, or whether it's a massive dividend like qyld pays. Every single position in my portfolio need to pay a dividend. And that's because although I want my portfolio and my net worth to move up over time, I'm very particular in the fact that I want my dividend income to be increasing over time also. And this is because maybe in the next few years, I want to use some of my dividend income once it gets to a certain point to maybe use for things like bills, vacations, maybe help family and friends, and maybe someday in the future completely stop working altogether and live off my dividend income solely. Now, just because that's my strategy, just because that's the strategy that I came up with around 7 or so years ago, does not necessarily mean that it's the right strategy. It does not necessarily mean that it's a strategy that you guys need to choose, but I do think that it's important to somewhat come up with a strategy, come up with a game plan, and stick to it. This has made it very easy for me over the years, especially when the market is going crazy. If the market is super green or super red, and trust me, I've lived through multiple different situations of both. The strategy always remains the same for the most part, although the strategy can shift a little bit here and there, no problem with that, but the strategy has always been consistent. Buy into more single stocks and or ETFs at this point, which, side note, I really like ETFs, that's pretty much all I buy these days. But buy into high quality stuff that you think is going to move up over time, but on top of that, that all pay cash flow, either monthly or quarterly. So coming up with a plan is something I always tell newer investors when they ask me where to start. Come up with a plan. You can always change the plan later on, but try to think hard about it and ask yourself, what are you really trying to solve for here? Like I told you, I'm trying to solve for cash flow, but on top of that, maybe secondary, I also want to see my net worth move up also. So there we have it, guys. Those are 5 different things that I wish I would have known when I first started dividend investing. I still remember like it was yesterday buying my first few shares of Capital One stock and Realty Income, and honestly having no idea what I was doing whatsoever. But now I want to hear from you guys down below. What is the number one most important lesson that you would give to a brand new dividend growth investor as of today? Tell us in the comments down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.